Hello, welcome to accounting. My name is Patrick King. Today I will be discussing the tools for financial statement analysis. The tools to analyze financial statements will allow you to see beyond the numbers and help you manage and learn how effective your business is. The tools are important for any business, small or large, to help owners manage and measure the performance of their business, or auditors to see the financial health of the business, and financial analysts to look at the business stock investments. The tools to analyze financial statements are used in three ways. First tool is to analyze the statements vertical. This will provide a way to compare the company with other companies. Second tool is analyze the statements horizontal, to compare the company's performance from year to year and in different periods. Last tool is to perform the ratio analysis of the statements to determine the company's performance. This way is known to be the most effective tool to allow the company to compare themselves with other companies within their industry. First tool is vertical analysis. Vertical analysis of the financial statements will show the comparison of each item in each statement to its base amount at 100%. Nextly, every other item is reported as a percentage of that base and of each statement from the income statement, net sales, balance sheet, and total assets. Below is the formula used to analyze the vertical analysis percentages for this tool. Secondly is analyze the financial statements horizontal. This will compare the business's performance from year to year. This process is split in two steps. First step is to calculate the change in dollar amount from the beginning of the accounting period to the end. Next step is dividing the change in the dollar amount from the base period, or as we say, the beginning of that period. Many decisions hinge on whether these numbers in sales, expenses, and incomes, for example, are increasing or decreasing. Last tool as the most important tool is performing the ratio analysis for the company. This is a split into different aspects of the company to get different ratios. First one is evaluating the ability to pay current liabilities. Second is evaluating the ability to sell merchandise, inventory, and collect receivables. Next is evaluating the ability to pay long-term debt. Then you will evaluate your profits and evaluate stock investments. Once you obtain the ratio of each aspect of your company, you can then compare your company's ratio with other businesses in the industry. These ratios and performance ratios of each company are provided and publicly available on online financial databases such as the Dow Jones and LexisNexis. The tools to analyze financial statements are vital for publicly traded companies because it allows their investors to know how their business is compared to others within their industry. When comparing these statements using the third tool, ratio analysis, to determine the financial ratios, investors can have strict ratio numbers to be met, and if not, they can pull their investment money. Lying about these numbers can be an ethical concern for your investors and your business future. To address this concern, the company can shorten their accounting cycle for their business to increase their numbers for that period if they feel they had bad numbers late in the year, and could push these numbers to the next accounting cycle to increase their ratio from year to year, or accounting period from year to year. References I used for this were from Horton's Accounting, Corporate Finance, and the Life Application of the Study Bible.